everybody. Welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we're getting started, let's do a quick systems check. If you would, type OK in the chat box if you're hearing me clearly and seeing my screen all right. I know there are a number of you just signing in, so we'll just take our time getting started. Looks like we're up and running fine. If anyone has any issues as we go along with audio or anything, just let me know. But it looks for now like we're up and running. I'm going to go ahead and move forward through the disclosure and such. Keep in mind that each trade that you take has risk. I think we all understand that. So you want to manage risk in a way that makes sense for yourself, whether that be using some of the special tools that we have in our WebTrader and app, which we'll go over, or some other methods that help you to manage risk. You should do so in a way that makes sense for yourself. And also keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Today will be a little bit of a muted day in terms of the amount of fundamental news from the economic calendar, in particular, because it's a holiday in the US, and so there aren't announcements coming out of the US today. To any US citizens out there, expatriates, that might be attending, happy Thanksgiving to you. And so real quick, what is fundamental analysis? It's the news, basically. It's looking at what's happening around the world, whether it's through economic announcements or some sort of extraordinary event that's occurring. Certainly these types of news, events and headlines that can come out can move the markets, and a lot of times it's doesn't matter if it's a big story out of the US or out of Australia or out of the European Union. If it's a big enough headline, it can move the markets globally. But many times also you'll see particular markets affected by particular announcements or certain headlines. And so we'll take a look at what's happening today in that regard and what has already happened, and try and get some idea about how the markets might move today and maybe tomorrow going into the weekend. Real quick, for anyone who tends to trade on the go, then you also can use the AvaTrade Go mobile app. It's found in the major app stores and has the same functionality as what we're about to use in the WebTrader. And it also trades on MT4 and MT5 accounts, just like our WebTrader does, but with the advanced functionality, obviously. So if we log in from the upper right corner here from our main website, we're in the WebTrader platform. And we can kind of jump right into some of the fundamental news that's going on today and tomorrow. If we look at the economic calendar, what we can see is today's kind of a slow day, as I mentioned. If we scroll down, we see after the European and UK announcements, there's nothing listed the rest of the day in terms of high importance. And so this is obviously connected to the US holiday. So I think what we'll do is move on into tomorrow's announcements. Now, tomorrow is a partial trading day in the US. It has shortened hours, but at least there are some hours where the US market is open. So you may find a bit better price action tomorrow compared to today. Today, you might expect more ranging type movements, and that might be a strategy to employ today, where you find nice support levels and resistance levels. They might be harder to break through, and they might actually go up and down between key price levels with a bit more regularity on a day like today, where the trading volume is expected to be a lot lower with it being a US holiday. Now, looking on to tomorrow, we can see a number of high-level announcements. And we can start with the inflation rate out of Japan. And so if we use the volatility tool for this high-level announcement that's coming tomorrow, we can analyze how have the movements moved in the past surrounding this announcement. And we can use different pairings: USD JPY, Euro JPY, GBP JPY. I tend to like the GBP JPY. There's a lot of nice movement with that pairing when there's volatility. And so because this is a high-level announcement, the inflation rate out of Japan, we would expect that there could be quite a bit of volatility and large movements around this announcement tomorrow. And so as we look, we can look back at the past announcements. That's what these represent, the date and time of the past announcements and how much movement there was on this pairing in the hours following the last announcements. And so let's qualify how the results came in and say, if the results came in above forecast, how did the GBP JPY pairing move after such announcements? And we can see that 2/3 of the time the yen pulled down the pound if the inflation rate came in above forecast. So kind of makes sense. The yen might strengthen if it shows higher inflation than expected in Japan. And so 2/3 of the time, approximately, we see the yen pull the pound down in the 4 hours following the announcement if these numbers come in above forecast. And so we can even see the range movement, nearly 60 pips, 58.8 pips. And you can check and say, okay, so it looks like the majority of the time it went down, but that's after the numbers came in. What good does that do me? And what you can see is if I say that I want to place a trade within 5 minutes of those numbers coming in the first 5 minutes, look, everything was up. All of the movements went up in the first 5 minutes. So I would have time to say, okay, I know from the statistics in the past that 2/3 of the time this movement drops in the coming hours with a large range movement, like 50 pips range movement. After 4 hours, we were looking at, well, in the first 5 minutes, look what can happen. You can actually get a higher point with only 10 pips range movement. And then after 4 hours, if you sold within those first 5 minutes, 2/3 of the time, 67% of the time, it ended up down, okay, with 58.8 pips range movement. So we're looking 20, 30 pips, potential dropping even more from the high point that you could catch after the first 5 minutes. So if that happens again, you could have a trading plan that if this came in above forecast, if it comes in above forecast tomorrow, that then you have a rule that if it spikes up in the first 5 minutes, maybe you'll sell with a stop loss a certain distance away and you take profit a certain distance. And you understand the distances that you would put, maybe 15 pip stop loss and 30 pip take profit, because you can see the amount of range movement that occurred in the past with this announcement. And the one that went the wrong way, maybe you'd have a very small loss because you'd be starting from a higher point anyways in that first 5 minutes. Okay, so just some ideas using data from the past to create a trading strategy that you don't have to guess about what you're going to do. You have the data showing you statistically what would have worked in the past. And it doesn't guarantee that every time you do this, it'll work moving forward. I mean, you can even see from the statistics in the past that there was one time you would have lost and 2 times you would have won. Okay, now what if it comes in the opposite? Instead of above forecast, what if it comes in below forecast? 100% of the time it went up. Okay, 3 out of 3 times in the past, if the data came in below forecast, then the yen weakened and the pound went up. And again, you could say, okay, 61 pips range movement, but what happened in the first 5 minutes? Okay, only 14 pips movement. It looks like a big movement, but this was up 2 pips, 6 pips, and 21 pips in the first 5 minutes. And then after 4 hours, we're talking up 56 pips, 50 pips, and 6 pips. So it looks like 2 out of 3 times you'd have had a huge gain in these ones if you had within the first 5 minutes, but when these numbers came in below forecast, you'd have won big on 2 of them and maybe a small gain on the 3rd. Okay, and that's having the benefit of seeing the data come in first. Is it above or below forecast, and getting your trade off in those first 5 minutes when there's a smaller range movement compared to what happens after 4 hours. Okay, so a couple different directions you could trade on the same announcement depending how it comes in. You say, well, what if it matches the forecast? It could. If it matches the forecast, what has happened in the past, not as strong of a statistical advantage. 60% down, 40% up. I might sit that one out if it came in and matched the forecast. You're probably hoping it's above or below the expected number, because then that gives you a statistical advantage from the past. Okay, and so this can be your plan going into this announcement tomorrow. Okay, now we can look at some others. We've got out of Germany, GDP growth rate. We can take a look at that and see what type of movement did we have on in the past. It's expected to drop, by the way, from 0% growth to negative 0.3. As long as they're listed medium or high, they tend to have a pretty nice effect with movements on the charts. So if we go to the volatility tool for this announcement, we could leave Euro USD pairing if we want. We could put GBP, Euro GBP. As long as it has the Euro involved here, you can pick different pairings. Now, if we then get selective and say, 75% of the time the Euro dropped against the USD regardless of how the numbers came in, if we're looking at all events, okay? So just from the beginning, you start to see, looks like when these numbers come in, it would make sense to sell. But let's dig in a little deeper and see if this comes in below forecast. 100% of the time, it made sense in the past to sell, okay? So a decent amount of dropping with a high percent probability from the past data that if this comes in below forecast, it certainly leads to, in the past anyways, the USD pulling the Euro down. And if we switch and go above forecast, it also led to the dropping of the Euro against the USD, okay, with only one data point for that particular announcement. And if it matched the forecast, it went up, okay? So it looks like you have the most data here that if this comes in below forecast, you have 2 data points telling you that then the Euro should drop against the USD. And so this might be selectively what I'd be waiting for, is to see if this indeed came in below forecast, okay? You may or may not want to trade on the medium level announcements. With that data, you can see it's not dropping it's not moving as much. In that 4-hour period, it's only 29 pips movement, as opposed to the other announcement we just looked at, which had 50 or 60 pips movement in those 4 hours. So less price action on Euro USD. We could check Euro JPY. Okay, the JPY pairings tend to have larger movements, and indeed we see then 64 pip movement in those 4 hours. But then look at the predictability. Larger movement, but 50-50 on the predictability with all events. Let's switch and go to above forecast, 100% up with 89 pips movement. That looks nice. Actual below forecast, 50-50 on dropping. So if I'm using the Euro JPY pairing, if this comes in below forecast, I'm not interested in trading. It's 50-50. If this comes in above forecast, then it looks like I probably should buy, as it went up in the past in a huge way. Okay, like 70 pips plus climb in the 4 hours after the event. And in the first 5 minutes, it had only gone up about 8 pips. Yeah, even less, 5 pips. Okay, so you can analyze this data, come up with a trading plan. It looks like on this one, I would prefer to have Euro JPY pairing and only trade if the data comes in the direction that shows this high probability 100% of the time climbing. Okay, so if it comes in above forecast, go with the Euro against the yen. Okay, that's what the statistics from the past show. Again, you're not going to win every time doing this, but this can be a powerful tool to trade based on data. And then we can come down and look at the retail sales out of Canada, which is a high-level announcement. And this one, I think we should see some pretty strong data. Retail sales have been a pretty strong focus. If we look at USD Canadian, if this comes in above forecast, 2/3 of the time, the Canadian pulls the USD down. That makes sense. If retail sales are higher than expected, above forecast in Canada, then the Canadian dollar strengthens against the USD 2/3 of the time. with a pretty big range of movement, 63 pips. If this comes in below forecast, the USD strengthened 100% of the time. So pretty one-to-one relationship here. If the data disappoints, it comes in below forecast out of Canada on retail sales, USD has pulled the Canadian dollar down quite significantly. Okay, 58 pip. I mean, the USD has gone up against the Canadian quite significantly. Average range movement of over 58 pips. Okay, and if it's the opposite, comes in above forecast, then the Canadian strengthens and pulls the USD down 2/3 of the time. So this looks like one I'd probably be interested in if I'm available when the numbers come out, having a plan to trade on depending on how the numbers come in. Okay, and again, if it matches the forecast, also you can have a plan. If it matches forecast, it's 50-50. And my plan would be that I won't trade on it because 50-50 doesn't give me any type of statistical advantage from the past. Okay, not in my eyes anyways. Any questions at this point? I'll pause for a moment. And so if you're making a list, there are several announcements tomorrow that you might be interested in. That JPY announcement, which comes up before the others. Then we took a look at an announcement out of Germany, which there are a couple. There's growth rate, GDP growth rate. Didn't have as much movement as the Japanese yen announcement. So you may or may not decide to trade on that one. There's another large announcement out of Germany, the IFO business climate. You could have a look at that one. But the one we really focused in on here, lastly, was the retail sales out of Canada, which really has a nice statistical breakdown from the past announcements. If it comes in higher or lower than expected, a great deal of certainty in the movement based on the past data. Okay, so some pretty nice opportunities potentially tomorrow, depending on how those numbers come in. Now, we can also take a look at the market buzz and see, are there any headlines coming in? And we need to focus on U.S. stocks. Can't be a focus today because the U.S. market is closed. So U.S. stocks, when the U.S. market opens, will not be tradable. Right now, the U.S. 500 with us, the U.S. indices, because they're traded on the futures, they are moving. I think muted movement because we're heading into a holiday. And once the U.S. markets reach the time that they would normally be open, then those instruments, the U.S. indices also will become not tradable. So I think we need to focus on other markets other than U.S. stocks. And so we could start to look for stocks out of other countries, or we could look in other categories like cryptocurrencies, commodities, indices from other countries, etc. And so maybe we go to the indices and we try and look elsewhere around the world. And so we've got the CAC 40 here we can look at and see. First of all, you get a breakdown. The price is expected to rise 2.5%. You can look at the technical analysis of that. The resistance levels are up this direction. They give you the prices and the direction that it's expected to move. But also we can then look at articles related to trading on this index. Okay. European stocks see light changes at the open of the market today. CAC 40, stable trend after PMIs. Wall Street on vacation. If you want to read what they're talking about there, just click the article. You can get a synopsis. And also, story continues. You can read the whole article. So this is taking into account that Wall Street will be closed, vacation day, and that the PMI numbers were solid out of the European Union. So it's having an effect maybe on some indices, including the CAC 40 apparently. Within this article, it's discussed. Okay, so real quick, you can find, without much trouble at all, articles to help you understand how you might want to trade on different instruments. And this is an important part of trading, is checking the headlines. What's happening fundamentally with what you want to trade on, then go to the chart and try and find entry points and exit points, okay? So if we want to go to the CAC 40, now it seems like the technical signal is that it would rise. The articles are showing some news about the PMI data, etc., as to why it might rise. And so then we can just come here and in the search find the CAC 40 and see what the entry point, exit points look like. Okay, 2-hour candles show indeed it is rising, has been rising, and we can look at the smaller candles and see if maybe there's a spot where you'd be interested in trading. Okay, and so it's possible that you might not be interested in trading right away. Maybe you say if it pulls back to a certain level, that then you'd be interested. It is an uptrend, but it seems to be pulling back. If it comes to a level of old resistance, which could be new support, maybe that's a spot where you have a pending order, then to go with the signal, which was a buy, and the fundamental news, which also seemed to be saying buy from the PMI data. So whether you like the entry point or not, it's up to each individual trader, but then you can take a look and see if you can put a pending order to get the entry point maybe that you want and be selective about it. There's a request to look at some commodities. We can look at something like gold. We could also look at crude oil. Crude oil really pulled down quite a bit. We can see gold here kind of meandering sideways. Again, with the US market closed today because of the holiday, this could be a day to take advantage of that type of situation for ranging movements. And you can see this is a tightening snake going sideways. It's slithering back and forth, and each time it goes up and down, it's getting tighter and tighter and tighter. Okay, so eventually, when it's tightening like this, okay, we can see it's tightening in this way and this way. Eventually, this will get pinched here tight enough that it has to break out one way or the other. Okay, and if it does, it likely will find resistance at the high up here. Here's the resistance, or the low down here. Here's the support. Okay, and I can get rid of some of these old lines. So just a bit of technical analysis to go along with our fundamental news situation, which is US market holiday, and ranging movements may be expected today before all of those announcements tomorrow. So we're right in the middle of the resistance up here and the support down here. So what you could do is wait for this snaking movement to break out one direction or the other and have pending orders just above the support to buy and just below the resistance to sell. And your stop loss could be above the resistance here for your sell pending order, and your stop loss down here could be just below the support with your buy pending order. And the idea of trading on this type of movement, ranging movement up and down, is that you feel like fundamentally there's not enough trading volume or large scale news to break the support or resistance, or that it's more likely not to break it than it is to break it. Okay, and so I kind of mentioned that starting the session out today, that on a day like today, we looked at big announcements, but they're tomorrow. Okay, so we went over a plan for fundamental news trading tomorrow on those announcements. But then today, the fundamental news situation dictates that there aren't big announcements left yet today, really. And so ranging movements could be expected. Now, there can always be an unexpected headline, right? That could really move the markets. But barring some big news story headline hitting the news cycle unexpectedly, we could continue to see ranging movements like we've seen today, okay, and even into yesterday. So selling from the resistance, stop loss above, buying from the support, stop loss below, could make sense, okay? And if you want to do that, it's very simple to set up, okay? If I want to do a buy pending order, I would do execute when price hits. If I'm buying from the support down here, maybe around 1888, which would be, let me just slide the line up, 1888 would be right about there, okay? Buying from here. So, I'm sorry, 1988. 1888, we might be waiting quite a while for it to hit there. So 1988, buy if it hits 1988. Stop loss would be down below this support, which would be down at about, let's say 1982.50. Okay, so right about there or a little lower would be the stop loss, which is below the support level. So 1982.50. For a stop loss, and then take profit would be before the resistance up here. Okay, the resistance is at about 2005, so maybe we'd be looking at just below 2000 might make sense because that's an even number, 2000. So if we say take profit at 1999, then it doesn't have to break 2000 to hit the take profit. And what we'd be looking at is about double the possible profit compared to the risk, okay? And so if indeed this ranges up and down and reaches near the resistance and support each time, we've got an opportunity to buy from near the support, risking approximately half of what we could make. And now you just need to adjust the trade size to be the amount of risk that would make sense to you. So if I go one lot as opposed to 5, now I'm risking 550. Maybe I'm comfortable risking 550 to go after 1100. Whatever amount fits into your risk management plan. Once you've got the entry points and exit points lined up for the trading strategy, then you adjust the trade size to fit that trading strategy. And so if I want to risk 500 per trade, then I just need to go a little bit smaller here, 0.9. And so now I'm risking 495 to make 990. Okay, so I can go ahead and set that as a pending order. You see it's listed in the orders, not the open trades, not the positions, because it'll only open if it reaches the strike price. Okay, now I can also set up in the opposite direction on the same instrument. So if I indeed think it'll range, I could win on both of these quite easily if it's a ranging movement still today and moving into tomorrow. So I could do execute when price hits as a sell now. If it hits the resistance up here, let's say 1999, right? Just before the resistance, just before 2000. So if the price hits 1999, just before 2000, then sell. Take profit down here at 1988. Okay. And stop loss above the resistance, which is up here, will go about $10 up to get above 2000. So we'd be looking at stop loss at 2009. Okay, that would be almost 1-to-1 ratio. So then you have to start to think, okay, the support level is actually down a little lower. So maybe I'll be a little more liberal with my take profit down to 1985. It still doesn't have to break this support down here. So take profit, 1985. And since I think 2000 as a round number might act as natural resistance up here, then maybe I don't need my stop loss all the way up to 2009. Maybe I have it more like 2006. Okay, just to get above this spike over here and above all of this with my stop loss. Assuming there's not much momentum, it would probably have trouble breaking that far above 2000. So now I start to look and I say, again, I have 2-to-1 ratio now. So I only have to be right on one of these trades, the first one or the second one, and I can break even or maybe even have a small profit. Okay, and if I'm right on both, I have a really nice payday. So now I need to adjust the trade size again. So I've got the entry points and exit points set up for my risk management plan and for the trading strategy of ranging movement on a market holiday in the US. Lower trading volume many times can equal ranging movements. And so now I just need to adjust my trade size. So you see how the strategy, it's a technical trading strategy, but it's being implemented because of the fundamental news situation being a holiday in the US. So now I'm risking 700 on this. Go a little lower, 0.8. Now I'm risking 560. Probably 7.5 will do it. Get me near 500. Okay, so now I'm near my target risk of around 500. 504 and possible profit 1008. Okay, so that sell pending order is in now. So now I'm in a situation where for sure I will have a trade on gold. I don't know when, but for sure I'll have a trade because at some point it will either reach this resistance or it will reach this support. And whichever one it reaches, it'll buy from down here or it'll sell from up here with a take profit in the opposite direction before the important price levels that we've identified. So ranging movements could equal nice payout here. And I might undo this strategy if it doesn't trigger the trades by tomorrow morning. Okay, because as we move into tomorrow morning, we get near those large announcements that are coming tomorrow. And this strategy then of trading on a ranging movement would make a lot less sense because with those large movements coming, we might experience a big breakout move in one direction or the other. And that would be time to switch the strategy tomorrow. Today's strategy, ranging movements with pending orders up and down. Tomorrow's strategy could be breakout pending orders with a pending order down here to sell if it breaks through the support and a pending order up here to buy if it breaks through the resistance and well above 2000. Okay, different strategy tomorrow than what you'd have now with this type of setup because of the way the fundamental news sets up today compared to tomorrow. So you can start to see the idea here of changing your technical trading strategy based on how does the fundamental news set up. Am I going to trade on ranging or am I going to trade on breakthrough moves? Okay. Any questions, comments before we end things on the session? And yes, I can go ahead and bring up crude oil. I know the request was commodities, and we looked at one. Let's look at another one. And if we go to larger candles like 1 day, we can see there's been quite a downtrend with crude oil. And let me get rid of some of these old lines. Why the downtrend on crude oil? The numbers keep showing out of the US, European Union, other places that this really high inflation is really coming down even faster than expected, especially out of the US, which means the economy is slowing down. And when the economy slows down, there's anticipation of future demand drop for energy. So these huge drops in CPI, PPI data, factory production numbers, et cetera, which were intended to happen with the high interest rates to bring down the inflation. Now those numbers are dropping so fast that there's fear of economic slowdown potentially, and that can help crude oil to drop. Okay, and we've seen that over the past weeks on the 1 day candles. Okay, now the question is, where will crude oil find support and maybe start to come back up? And so if we start to see good economic data, like we saw out of the European Union today, okay, the PPI data, some numbers that came out of the European Union were better than expected. The euro strengthened on that. And so those types of numbers coming in could help bounce crude oil back up. So if you're looking for an opportunistic entry point to buy on crude oil, thinking that, okay, there could be some positive data eventually that'll bounce crude oil back up, then this has been a large drop off from near 100 a barrel down to 76 and change a barrel right now. So it wouldn't take much risk if you wanted to buy, for example, on crude oil, if you're anticipating a jump back up, to get your stop loss below these low points here. It's about $6 down, or $5 down, I should say, per barrel, to get your stop loss below all of these 1 day candles. and go after maybe double that to a resistance level like up here. Okay, see, this was support, 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 and then once it broke below there, it became resistance up here. So it looks like it could easily, if there is an uptrend, try to get back up near 88 to 90 a barrel because we find resistance here. So I drew the line just below that resistance. And I'm not saying you have to think this way, but if you feel like after all this rapid dropping in crude oil price that it's bound to come back up some, and that, you know, just any positive economic data, especially through the holiday season, where there's a lot of extra spending, retail sales, etc. If you think there could be some data that would bounce crude oil back up, then you could go after a profit of about $12.50 per barrel up to here without breaking this resistance or even having to get near the high of 100 a barrel or so that it was at recently. You could get a good $12.50 gain per barrel and risk only $5 or so per barrel. So better than 2-to-1 ratio potential profit to risk. And then just set your trade size to a trade size that makes sense in terms of risk. So I can simulate that. If I'm looking to just go on a potential bounce here through the holiday season where we know there's a lot of extra sales and such going on that could pump the numbers up maybe in the coming weeks, then take profit. We could say 88 a barrel up here. We could even be less aggressive and come down and say 87.9, which is just before this resistance level. So take profit 87.9. And so this isn't on data that we know. This is on anticipation of potential improved economic data over the next month or a month and a half with all the extra retail sales and such that typically happen this time of year, especially in the US with between Thanksgiving and Christmas. A lot of extra spending typically, and even hiring can affect jobs numbers as well and bloat them to make them look stronger than maybe what the economy actually is. So what we can do is anticipate that from a fundamental perspective, but with a measured risk, because maybe the numbers disappoint, you never know. And so stop loss at 71.5. That gets below all of those recent lows. We'd have to break to a new low for the past months to hit 71.5. Okay, that's down right about there, 71.5. Would have to be below all of this to where it hasn't been seen since July. Okay, and so take profit at 87.9. That's a spot where it was just a few weeks back. So doesn't have to do anything crazy to hit the take profit. It has to break below a several month low in order to hit the stop loss. And that's kind of an opportunistic entry point because of all the dropping it's done over the past weeks. And if fundamentally you think there's a chance that the fundamentals could be on your side, then this can make total sense, okay? So different styles of fundamental analysis. This is a style of not looking at an economic announcement or looking at a recent headline. It's a seasonal look at what might happen or could happen in your mind through a certain season, like the holiday season in the US, the Christmas season, through Europe and the US, etc. Okay, so and obviously other areas, Australia, it affects globally really, many countries through the Christmas season, holiday season, etc. Okay, so better than 2-to-1, but maybe I don't want to risk $31,000, right? So I better adjust my trade size because I went quite a distance away in the price, over $5 or about $5 away in the price of crude oil. So with half a lot, I'm risking 2,400. With 0.1 lots, I'm risking, there's my 500, right? I'm under 500 to go after over 1,100 in profit. So better than 2-to-1 ratio. If I want to be right at 500, I'll do 11.11, 528. That's a little above. So I'd rather be a little below with my risk than above. So I'm risking 481 or so to make 1159. And so I just go ahead and buy on that now. That's a market move, okay? So some examples of pending orders for a ranging strategy, a market move based on long-term fundamental seasonal outlook, and then the announcements tomorrow are a third fundamental strategy that you could use as the numbers coming in, using what we call data-driven trading with those announcements tomorrow from the economic calendar that we looked at. Okay. All right, everybody, I think this is a good place to stop. Any last questions, comments before I end things? Okay, great. Thank you all for participating. Looks like everyone stayed with us the whole time, so I must not have bored anybody. I didn't see anyone drop out. So thank you for attending. Happy holidays to you if you're celebrating Thanksgiving and upcoming Christmas holidays, etc. And the other holidays, of course, I guess less commonly mentioned, but whether it's Kwanzaa or some of the other holidays that we're about to come through. Happy holidays to everybody, actually, from now to the end of the season. All right, everyone, thank you for joining. Until next time, good luck with your trading. Good question. My next webinar is on Tuesday. It's always Tuesday, Thursday, Graham. So my Tuesday session is later, 6 p.m. UK time, and my Thursday session is like today. Okay, barring holidays or unexpected events, that's the schedule each week.